Before you buy, sell, or even hold SCHD in 2025, stop and watch this. What if I told you the popular dividend ETF just went through one of its biggest shakeups yet, and most investors aren't even paying attention? Major companies are out, new players are in, its sector exposure has shifted dramatically, and if you're not watching closely, you might be holding a completely different ETF than you think. In this video, we'll break down everything you need to know, what changed inside SCHD, how those changes affect its future performance, what dividend investors should expect this year, and whether SCHD still belongs in your long-term portfolio. Most people blindly trust past performance, but that's a mistake. The market's changing fast, and SCHD's future might look very different from its past. Stick with me till the end and you'll walk away with clarity, confidence, and a smarter perspective on one of the most talked about dividend ETFs in the market. Let's get into it. Chapter 1, 2025 Portfolio Reshuffle. Key adjustments in SCHD's lineup. Each year, SCHD adjusts its stock list to stay in line with its strategy, focusing on stable, dividend-strong businesses with solid fundamentals. For 2025, the changes were noticeable. 20 fresh stocks were brought in. 17 previous names were let go. Some of the exits may surprise you. Companies like Pfizer, Amgen, and BlackRock are no longer included. On the flip side, major players like ConocoPhillips, ExxonMobil, and Valero Energy have taken top positions. Here's something big. Energy companies now make up more than 20% of SCHD's total portfolio. That's a significant increase compared to past years. Why should you care? Because energy stocks can swing hard. When prices are high, profits soar. But in downturns, dividends could get slashed, and that's a risk investors need to watch. Even with this shift, SCHD has not abandoned its roots. It's still locked in on picking strong, reliable companies with a solid track record of paying dividends. But with this shake-up in sectors, the big question is, will the results hold up going forward? Chapter 2, Looking Back, SCHD's past performance. Let's rewind and see how SCHD has performed through the years. Between 2011 and 2022, SCHD delivered an impressive 325% total return, a number that actually beat the S&P 500, which returned 290% in the same stretch. That's a standout performance for a dividend-focused fund. But after 2022, the tables turned. Tech stocks exploded due to the AI boom, and the S&P 500 surged by 61%. In comparison, SCHD lagged with a more modest 25% gain. Still, it's not all downside. Even during turbulent markets, SCHD held its ground, delivering a solid 13% return in one rough year, proving its resilience. Other dividend ETFs like DGRW and HDV had stronger showings recently, with 25% and 20% gains respectively, placing SCHD behind the pack in short-term growth. But here's where SCHD shines: stability. While tech-heavy indexes rise fast and fall hard, SCHD's value-based approach helps it weather the storms. So yes, while it hasn't been leading lately, its past success and ability to stay steady during chaos still make it a worthy contender. And remember, the numbers speak for themselves. Previous success doesn't guarantee what's next. What truly matters now is what makes up SCHD today. We've already looked back, strong during tough markets, but didn't keep up when tech stocks exploded. Chapter 3, Inside SCHD's 2025 Structure. Let's break down SCHD's latest setup for 2025. It holds a variety of industries, but it's clearly tilted toward value-based stocks. Here's how it's distributed. Banks and financial services lead with roughly 20%. Healthcare-related firms are next, around 15%. Consumer staples and energy companies each take up 13.3%. Industrial businesses come in at 12%. As for technology, only about 10% of the portfolio, much lower than the S&P 500's 30% or QQQ's 50% tech stake. SCHD isn't trying to win the tech race. Now, here's a major update. This year, the fund reshuffled its assets. 20 companies were included and 17 were removed. Pfizer exited. ConocoPhillips entered. This move pushed energy stocks past the 20% mark. That's a notable change, showing confidence in oil and gas industries. What's the core identity of SCHD? It leans on consistent, dependable sectors, banking, health, food and fuel. Unlike the S&P 500 or QQQ, it avoids chasing the tech-heavy giants like Apple, Microsoft, Tesla and Nvidia. SCHD's focused on stability over speculation. Now, can this formula succeed in 2025? Here's what could play out. Financials may benefit from relaxed oversight. Energy stocks might climb if global policies shift. Technology could slow after rapid growth. SCHD is clearly sticking to its theme. Value-driven picks aimed at steady income and long-term strength. Lower risk, high resilience, that's the foundation SCHD is building on. Chapter 4, Dividend Snapshot. Now let's dive into the heart of SCHD, its dividend power. What kind of income are investors seeing? Right now, SCHD delivers a 3.3% yield. That's a solid annual return. And even better, it's been climbing steadily, with a 12% increase over the past 5 years. Even more impressive, SCHD's boosted its payouts every year for the last 12 years. That's serious consistency. Let's stack it up against a few other players. DGRW, a fund aimed at dividend growth, but its yield is only 1.49% and its 5-year dividend growth just 2.9%. No history of annual increases either. 0 years of raises. HDV, built for income, it's yielding 3.27%, nearly equal to SCHD, but its growth pace is slower. Only 4.8% over 5 years, and just 2 years of increases. SCHD comes out ahead, better yield and faster growth than DGRW, and it beats HDV on growth and consistency. Why is this important? Because growing dividends helps protect against inflation. Your money keeps its value as prices rise. HDV may offer decent payouts, but SCHD's blend of steady income and rising dividends is rare. It's not just about what you earn today, it's about what keeps growing tomorrow. So if you're looking for dependable cash flow, SCHD stands tall. But here's the real question. Can it maintain this momentum in 2025? So far, the data's encouraging. Strong yield, rapid growth, solid track record. Chapter 5, What's ahead in 2025? Let's turn the page and look toward the year ahead. The economic landscape in 2025 is shaping up with a few key themes. Interest rates remain elevated, overall growth may cool, and value-oriented stocks could take the spotlight. Where does SCHD stand in 2025? So, how does SCHD fit into today's landscape? It's heavily concentrated in finance and energy, sectors that could benefit if government rules ease up. Think of a second Trump administration. Banks might gain flexibility and the oil sector could thrive. On the flip side, technology stocks are on a shakier ground. With sky-high prices, many are expecting a cooldown. SCHD only has about 10% exposure to tech, much lower than funds like QQQ or ARKK, which are loaded with high-growth names. When interest rates climbed before, those growth ETFs tumbled, but SCHD remained stable. Its low volatility helps it ride through rough patches, and a 3.3% dividend yield becomes even more attractive when bond returns are underwhelming. Right now, investors are looking for consistent income, and value-focused strategies are back in style. Funds like QQQ chase massive returns, but they also take bigger hits during downturns. SCHD follows a slower, steadier path, and in an environment with higher borrowing costs, that strategy might shine. Now, if tech continues to outperform, SCHD could fall behind in comparison, but when markets are uncertain, its strengths become clear. Reliable payouts and strong fundamentals. It's not flashy, but it's built to last. SCHD is designed for conditions like these. Chapter 6. What makes SCHD stand out? Let's break down the advantages. Very low fees. Its expense ratio is just 0.06%. So more of your returns stay in your pocket. Solid yield. 3.3% provides a steady income stream. Strong dividend growth. 12% increase over the last 5 years. Stays steady in turbulence. Its low volatility and consistent strategy offer peace of mind. Tax efficiency. Minimal portfolio turnover means fewer taxable events. So when it comes to cost control and dependable cash flow, SCHD has a clear edge. It's a fund with real strengths, especially when stability matters most. Chapter 7. Risks and limitations. SCHD delivers low expenses and reliable income, but it's not without concerns. Let's look at the challenges. Industry concentration. Recent changes have increased SCHD's weight in energy and industrial sectors. If either group underperforms, it could drag down the fund's overall results. Energy stock volatility. Energy is known for big swings. When prices fall, so can dividend payouts. Interest rate pressure. When borrowing costs stay high, income-focused stocks can lose favor. Investors may shift to bonds or safer alternatives if rates remain elevated in 2025. Slower dividend growth potential. In the past, SCHD raised dividends impressively, but its new stock mix may not grow payouts at the same pace. If fresh additions don't boost dividends regularly, future income growth could lose momentum. Wider market risks. Even though SCHD has held up well, it's still impacted by economic shifts. A recession, earnings decline, or major policy changes could all put pressure on performance. So, while SCHD is still a reliable fund, it's important to stay mindful of these headwinds. Final thought, is SCHD still a top dividend ETF for 2025? So where does SCHD stand after reviewing its latest updates, from portfolio changes to payouts to market conditions? Here's the bottom line. SCHD remains one of the strongest dividend ETFs available today. It's backed by a proven strategy, strong dividend history, and thoughtful stock selection. Add in low management fees and consistent income, and you've got a powerful long-term option. But let's be real, it's not flawless. With more energy in the mix and rates staying high, volatility and competition from other income investments are real factors. So, is this still the number one choice? That depends on your goals. If you want a blend of steady dividends, strong financials, and minimal management, SCHD still deserves a top spot on your list. But if you need higher yields or prefer less sector exposure, there are other ETFs that might suit you better. In the end, the best fund is the one that fits your financial plan. Drop your take in the comments. And, as always, thanks for watching. See you in the next one. Here's to your investing success. Profitable investing.